So I'm talking with an industry insider, a professional that's been doing the SFR and build for rent business for what, Bruce? Better part of a decade, not to date you?
It's been 16 years.
16 years. I love talking to Bruce McNeilage and Kinloch Partners because Bruce, I've come to know as a guy that is a serious investor, been doing this for a very long time, but he's a different animal than most of the buyers I usually work with who are normally large scale institutional investors. Bruce has made his way through the SFR industry while remaining relatively private and using your own capital to invest in real estate and to build a SFR portfolio, which you sold, and I'll let you give a little bit of your background. And now you're in the build for rent segment. And whenever I have a question about finances or how deals should pencil out, I come to Bruce and he gives me a pretty detailed and understandable analysis and advice. So I'm excited to have him on the podcast. Bruce, how you doing, man? How's everything?
Adam, thank you for having me. I appreciate it. Things are going well.
Yeah, it's great talking to you. I wanted to have you on today because I had done a video about how interest rates are affecting buyers of all sizes. And I kind of noted that, in my world, there's really three kinds of buyers. There's the institutional guys that securitize and they raise money via bond offerings, and they're institutional players. And then you have kind of the middle section of investors that are either private equity backed or privately funded like you, and you're affected by interest rates in a different way. And then you have all the smaller guys that are private accredited investors that get affected differently by rising interest rates. And I asked you yesterday, and the reason why I want to have you on the podcast, I asked you, how does rising interest rates affect different buyers in different ways? And you gave me a really good response, and I thought the rest of my audience would want to hear about it. So I guess that's the question I'm going to pose to you right now. In a rising interest rate environment like we have right now, where interest rates have risen 150 basis points in the last couple of months, how does it affect big-time buyers, institutional buyers, medium-sized buyers, and small-time buyers differently?
Well, sure, Adam. And again, thank you for having me on. As far as the cost of debt or what we're paying, our firm has some wonderful relationships with some large publicly traded banks and also some large community banks. And
Okay.
we were paying in the mid threes. We're now paying in the mid fives. That'll go to 6 in the next few weeks. And so whatever pro forma I was running, whatever numbers I was looking at, I'm going to miss the mark. And you can't pass along that additional cost to your tenants. Now, if your cost of money goes up 0.5%, 1%, you can probably fit it in the rent when you renew it in the future. But when you're talking 150, 200, 250 basis points, you can't pass all of that along. So what it's going to do is not only cause you to raise your rent and what you were possibly going to charge, but it's going to really cut into your margins, which will affect different firms in different ways. The large players have taken money from investors, from large funds, et cetera, and they're going to miss their mark. The numbers just aren't going to hit the mark, and they're not going to pencil. They're not going to hit their numbers. And so I think it's going to affect them a little bit differently than maybe a mid-tier investor like Kinloch Partners.
Let's back up for a sec. So and I want to attack the subject from the perspective of investors in the marketplace wondering how the demand side is going to change with rising interest rates. So let's differentiate. Kind of the way I look at it is you've got institutional investors that get their debt from a certain source. And then you've got medium-sized guys that get their debt from a different source. And you've got retail investors that get their debt from a different source. So can you draw a differentiation between where does Amherst get their debt from? Where does Progress Residential and Invitation Homes? How is their debt affected by rising interest rates in relation to or compared to where a guy like you, a medium-sized firm, gets their debt from? You're getting your debt from different places, and I'm unclear as to whether rising interest rate affects everyone equally or whether it affects people differently.
Yeah, so the rise in interest rates are going to really affect the smaller players greater than the larger players, and then the mid-tier players like Kinloch Partners will be affected, but somewhere between the larger players and the smaller. So it's going to hit our bottom line. It's going to hit the smaller players significantly. As far as the large institutional funds, they've been borrowing money from Goldman and Citibank and those other firms. The cost of their capital is going up, but because it's institutional and it's priced much lower to begin with, they're going to have increases, but the increases won't be as significant. And like you said, they securitize these assets, issue bonds on Wall Street. The bond's going to have to pay a better coupon. It's going to have to pay a better interest rate.
I
But
understand that. Yeah. Okay.
it's not going to be the same hit as it would be to the medium-sized or smaller investors.
So like those big guys are basically raising money by doing bond offerings. And what you're saying is they have to offer a higher coupon to their investors, which means their money is essentially being more expensive. Now take it from your cost of debt versus consumer cost of debt. What index is your debt tied to as opposed to consumer debt? Because I'm looking at like general interest rates for private investors, and they went from the mid 3s to the low 5s. Are you in that same range? Are you tied to the same index as consumers are?
Sure. So a lot of the larger funds are tied to LIBOR or SOFR, and then the smaller investors might be tied to the 10-year Treasury, the 5-year Treasury, and then 200, 300 basis points over one of those indices. At Kinloch, we're primarily tied to the 5-year Treasury because the rate guarantee we're getting or the amortization that we're getting is 20 to 25 year, but my rate is only fixed for 5 years. So the bank or lender matches a 5-year obligation with a 5-year investment. And so I'm naked after 6 years. I don't know what my rate is going to be. My goal is to either refinance at a reasonable debt, or it might force a firm like ours to sell or cull our portfolio and sell some of the portfolio just because the payments, the interest rate would become so high, it would further affect margins that would make continuing to own that particular portfolio at those rates, it just wouldn't make it attractive enough and it wouldn't pencil.
Okay, so you have smaller investors that they're taking out generally longer term debt at higher interest rates, and those are tied to longer term treasuries. And then you got medium-sized investors like you that are tied to midterm or shorter term treasuries, and you've got a lower interest rate because you're tied to a shorter term treasury. And then you got the biggest guys that are basically offering bonds out on Wall Street, and they're raising their debt through bond offerings, and they've got even a lower cost of debt. So that's interesting. For sellers thinking about possibly selling their portfolio, possibly selling their build for rent projects, how do you measure how aggressive a buyer might be or not be based upon current interest rates or based upon what their view of where interest rates are going? I got to assume if interest rates are going up, that people will start underwriting higher cost of debt because they think it's going in that direction, which means offer quality would have to go down. How do you guys deal with that reality?
So when you look at that, if I went to sell a portfolio, the buyer is going to need a discount on that portfolio. If I'm under contract, they'll want to retrade us because they've still have to meet their numbers. So let's say they're trying to achieve a 4% cap rate. Mm-hmm. If it's now going to hit at 3.8 or 3.7 because of cost of their debt has gone up, they're going to want me to reduce my price to compensate for that to get back up to the 4%. So the interest rate will affect me as the owner when I sell, but they don't want it to affect them whatsoever. And so in that particular scenario, the higher the interest rate becomes, if I'm trying to sell a portfolio, the lower and lower I'm going to have to discount it at a greater number. And so the lower my profit and yield is going to be on my portfolio. It's very unfortunate because the value of the asset, the rent that you're achieving, the rent increases can all be wiped out. And all of a sudden your houses become less valuable, not because there's anything inherently wrong with the portfolio or your ability to raise rents, but the buyer's cost of capital. I think what people forget is when you do houses, and they're penciling for you, they're going to pencil at a different number for the buyer. And so if you're designing your portfolio or building your portfolio to eventually sell, you've got to remember it's very important for what they need as far as cap rates and the interest that they're going to pay, because it's going to definitely come out the backside on you. And in this environment today, there are going to be retrades, there are going to be deals that fall through. And I think some people will have to adjust their cap rates. It probably won't be the major players. It'll be more than the smaller and the mid-tier companies that we're looking to sell a portfolio. They're going to be affected negatively the most.
This is something I always talk to portfolio owners about. It's possible that the value of real estate can keep going up, but the ability for a portfolio owner to sell their portfolio for the same or more money today than they can tomorrow might actually dissipate over time. Because, if you're selling on the retail market, the retail price is affected by what retail home buyers can pay, and that by and large is affected by how cheap or expensive their mortgage is. So God only knows, how higher interest rates are going to affect the retail home buyer market. There's still a dearth of inventory and there's still an undersupply of inventory. But I always kind of look at it from the perspective of, if you're going to sell a portfolio, it's possible your values can go up marginally, but the value of your portfolio can actually stay flat or even decrease, because the market of people that are able to buy your portfolio can only pay so much for it based upon their capital requirements, based on their debt that they have available to them. Do you find that to be true? Can real estate values go up while the price of a portfolio that you can get actually might go down?
I think where people make a mistake is they see home prices rising. They hear in this city, that city, things are going up 10, 15, 20%. And they see the cost or the pricing of these houses going up. But that doesn't mean that a portfolio of rental houses is going to go up $1, because individual houses that might be purchased one or two at a time by a small investor or by a family, those are based on retail pricing, supply and demand. But when you're buying a portfolio of houses, even if it's in the same model, or let's it's across the street, the same builder, those numbers can be dramatically different because people are buying a coupon. They're buying an income stream. And sometimes these institutional players will pay more than the retail value. Other times they'll pay less. So people get confused with a good market of individual houses rising in price or rising in value, where if the cost of money to an institution changes, that could actually decrease the value of that same house. And so they don't work in the same order. Sometimes one can go down and one can go up just because of the cost of capital, and also the cap rate the institutional a buyer has to achieve versus a mom and pop buyer. They might have to go into their pocket for another $100 or $200 a month, but that's not going to affect the price of the house because there's 10 other people waiting to buy the house if they fail. And actually the builders are able to raise the price of that house because they're now selling it at today's prices, where they might have locked in 3, 4, 5, 6 months ago at a lower price. So I see builders starting to profit from people failing and not closing on contracts, whereas most people would think it would be, to the contrary.
It's funny, a lot of the conversations I'm having with medium, small, even larger portfolio owners is like, you have to have a reason to sell. And generally the reason to sell is either you want to get rid of your properties and realize your profit and take some chips off the table and reduce your risk, or you're at a certain point in your life where you want to eliminate management responsibility, or you think your capital has been maximized in the current asset and you want to redeploy it into another asset where you can, get a better return. No matter what your reason is, everyone's asking themselves, is it a good time to sell today versus waiting a year or 2 years? Or did I miss the boat and did I miss the high water mark so far? And I can only, talk about my experience over the last, 3 months, 6 months, 9 months, 12 months. It seemed like 6 months ago, my business in terms of offer quality from institutional investors reached a fever pitch where I was more or less getting a premium to retail value on most of the portfolios that fit squarely in the center of the buy box of most of the large institutional funds. And even for the other ones that were like, not quite in the middle of the buy box, they were still getting at or a little above fair market value. But ever since interest rates have started to tick up, I feel like offer quality has suffered a little bit, so that if you look at where the offers are coming in today versus like a year and a half ago, it's still better today, but I feel like we're on the backside of the wave right now, and I don't know if it gets worse quicker or if it stays like this indefinitely, where it'll still be a really good time to sell a portfolio. Then the question becomes, how much longer is it going to stay good for? And there might come a day when the portfolio I could sell for retail value today, now it's a year or two into the future, and now I got to take a 10% discount in order to sell it as a portfolio. And when does that time happen? I know everyone's asking themselves the same question, about their exit timing.
So there's another big factor in addition to that is the price of raw materials, lumber, windows, all these things, and also a supply chain problem. How do I get that? Now with the cost of diesel and the fuel going up, that's further adding to the cost of materials because I've got to truck lumber 500 miles, from the Pacific Northwest, or my windows came in the port of Jacksonville and I've got to get them to Charlotte, right? And so it's a perfect storm. The cost of money is going up and the cost of materials, labor, land, development of land, diesel, all these things are a perfect storm. And so is it a good time to sell? Absolutely. But here's the problem with that. What are you going to deploy your capital in? If you can't deploy your capital in something and you don't want to sit on cash, that's something to think about. But if you want to sit on cash and conserve that cash because you think things will correct and then you want to take advantage of those corrections, it's great to have cash. They say cash is king, but I think buying a portfolio or selling a portfolio right now, it can be good for either, but you have to factor in what's important to you. Is it a liquidity event? You have to factor in taxes. What else is out there? Can you deploy your capital in something that is going to yield more or yield less? And then how much is that same asset? If you sell a house that you're going to gain value and it's going to grow and appreciate in value, but it's also going to say get you $2,000 a month in rent, you've got to go out and buy or build a portfolio of houses that will yield you more or cost you less. It's going to be very tough to build and create houses at a lower number.
Right.
Everything is going up. That's making the value of those houses going up, but it's not making the amount of rent go up. And, as you know, rents has been going up 10, 15, 20%. That can't continue. We're looking at more like a 5, 6, 7, 8% increase. But even that compounded, that $2,000 house is eventually going to become $3,000 or $3,500. People's wages just aren't going up at the same percentage.
Yeah.
So something has to give. Something has to give. Now, in that instance, I'm going to get more for my portfolio because there's just not enough portfolios and houses on the market. There's so much money flowing into this business that these firms have to place capital. Because they have to place capital, they have to, going forward, accept a lower yield because you just can't get the yields you used to get, and you still need those houses. Now, if you overpay for a house today, but you're going to own it for 10 years, is that really germane? And what does that add or subtract from the bottom line? 5, 10, 20 basis points. But if you're going to hold the asset for 3 years or 5 years, that change is much more significant. So it's also based on what the buyer needs and their hold period and what the seller is going to do with the money.
What I hear you saying is recently prices have been going up, rents have been going up, money's been pouring into the space, and interest rates have been relatively low and flat. But what inflection point has to happen for all that to change? Is it possible a year from now, when we're facing 7% interest rates, it's still going to be just as good of a time to sell a portfolio where you'll be able to get just as good of a price from a fund as you could today? And I know that's what everyone's kind of scared of. At what point do people start saying to themselves, it's now disadvantageous for me to sell my portfolio. I should wait until interest rates come down in order to get a better price, from investors that might be out there that are buying?
Yeah, so nobody knows, right? We don't have a crystal ball.
You don't? Oh, that's why I invited you on today. I thought you did.
I mean, I'm still waiting for a 1970 Mustang convertible to come back down to $3,000, which is what they were when they rolled up. They're not coming down. I'm waiting for a loaf of bread. I'm waiting for everything to come back down. Nothing is. And so there's no better time to buy houses or build houses, but there's no better time to sell them. It's a perfect storm. It's based on your cost of capital. It's very important on your hold time and your hold period, what you're going to do with that capital if there is a liquidity event, and what you need going forward. And so different buyers will pay different prices based on how patient their money is, what they think they're going to achieve in rent increases. But I'll tell you what, if you can pass along as much of these prices of money, of materials, of labor, of dirt, if you can pass a great amount, a large amount, percentage of that along to the tenant, then you don't have the problems. The minute the tenant can't pay for it and it's eating into your numbers and lowering your yield, it becomes a bigger and bigger issue. Now, we've got many, many more tenants. I don't have enough houses. Nobody has enough houses. We have 10 to 20 people apply for one house. And we are literally, for the first time in my career, renting houses before the other person moves out. So
Sure.
literally, you might have a day or two. People move out on the 30th. People move in on the 1st. It's already rented. Maybe you don't have to advertise it. You're calling off a list of 100 people that are on your waiting list. So if you can pass it along, great. If you can't pass it along, that's going to eat into your numbers. But the tenant base, the people that are looking to rent, is growing. And it's growing because they're failing to buy. So as mortgage interest rates continue to grow, that is the best thing to happen to the owners of SFR assets. But again, we don't have a crystal ball, so who knows?
It's interesting because I never really thought about it in the context of the higher interest rates go and the more expensive it is to buy a house because you got to pay more for a mortgage. Like when you compare what a mortgage payment might be in addition to taxes and like HOA fees for like an all-in cost of owning a house, you could actually afford to pay more in rent and still be below what you would essentially pay to own that house. So I never really thought about that fact. Higher interest rates is actually not a horrible thing for someone that owns rental properties because it basically means people can pay more in rent and still be below the payment that they might have for owning a house. And that's an interesting point.
Yeah. And also, if you're making $50,000 a year and your payment's going to go up by $200 on your mortgage because of rising mortgage rates, you're not going to buy the house. You have to walk away. But the problem is you have to live in a house. So rising interest rates as far as renting houses is the best thing that can happen. More and more people are going to fall out of the ability to own the American dream. And so they're going to have to rent it. Now, if you're an institutional player or a firm like us, and you've got to go out and borrow 10, 50, $100 million to do your next project, that's going to hurt you. But more and more people will be in your pool of potential renters. So you can be pickier. You can get more money, again, supply and demand for your houses. The question is, at what point can you raise your rent where you don't have any potential tenants or there's just no demand for your product? It's all based on supply and demand. And the worse it gets in the retail business of people being able to qualify on mortgages and close on houses, the worse that gets, the better it gets for an SFR B2R operator.
It's kind of a weird dichotomy. People talk about SFR being a recession-resistant asset class because of the reason you're saying. As people buy less houses, they'll be more inclined to rent, and that'll put upward pressure on rental rates. But the less people that are in the home buyer market, the more the downward pressure is on home prices. So while the asset value of the homes you own might be flat or not as highly appreciating, when that happens, it creates upward pressure on rents. So you kind of win on either side depending on what the economy is doing. Sounds like.
Yeah, and you also have a larger number of people looking for houses, which again creates a supply issue. You have baby boomers starting to retire. They're selling their houses, and many of them are fine with renting forever, or they're going on a vacation for years in a Winnebago, and they can go put all their stuff in a one-bedroom apartment, right? But there are more millennials that are looking to buy houses, and more millennials as far as a population than there are baby boomers. And so we aren't creating enough houses because you have a larger group of people looking to buy, and then you have a smaller group of people selling and renting. That again, with cost of materials, labor, interest rates, more people looking because of the greater number of millennials versus baby boomers. Again, it keeps creating that perfect storm that just makes this business so attractive. And they say real estate is a hedge against inflation. Imagine rental real estate where you're 100% full. It's a real
massive, it's a massive hedge against inflation because higher inflation gets, the higher you could push rents, essentially.
Most operators looking to lay off 100% of that. Now, can they do it now? Maybe as things keep going up in price, maybe it can only be a percentage. Nobody knows. But most firms like ours, larger, smaller, are able to push a lot of that off on the potential tenants that are looking to rent.
Bruce, as always, your insight is mostly understandable for a layperson like me, but always appreciated. I appreciate you spending some time and being with me and explaining all this.
I appreciate talking to you. Thank you for having me. And I hope it was information that people can understand. And I hope it's information that people can can benefit from with regards to utilizing some of that information to be more successful in their businesses.
Bruce McNeilage, Kinloch Partners, thanks a lot for being with us.
Thank you, Adam.
See ya. Thanks a lot for watching this episode of Inside SFR. If you like this episode, please subscribe. We're on all the major podcast platforms. Thanks for watching.